All right, and we are ready to start.
All right. Well, welcome everybody. I wish I could see you all virtually, but you're looking at the screen right now. And welcome to today's webinar on the effects of COVID-19 on CAM and operating expenses. My name is Mark Crone. I am with the RMR Group. I am an area director and also president of BOMA Austin. Just a few housekeeping items before we kick off the program. Today's program is being recorded and it will be shared later. Only the presenter and their presentation will be shown on the screen, as you can see right now, and Amy's lovely smiling face. Attendees will be allowed to post questions in the chat feature, so Amy will monitor that. We expect today's webinar to last approximately an hour. For those that wish to receive continuing education credit, please fill out the survey with your license number at the end of the program. So we're happy to offer that opportunity to you all. So let's jump into our featured sponsor today with Yellowstone Landscaping. Please welcome Emily LaFan to speak about her company. Emily?
Good morning. Thank you guys for having me. Hopefully everybody's kind of surviving the heat wave we're in right now. I just wanted to take a couple minutes and share a little bit about Yellowstone and who we are, what we do. We're a commercial landscape company serving the Austin metro area, which really covers Temple up to down to San Marcos and just as wide east and west, so a pretty large area here. We also have offices in Houston, Dallas, and McAllen. As far as services we offer landscape design, installation, irrigation, maintenance, general maintenance services for commercial properties. One thing I really enjoy that we do is we really utilize technology available for our industry to kind of streamline our services, get as much information to the client as we can in a really efficient way. So we have several different platforms that we use for anything from scheduling to bidding to irrigation inspection reports, site audit reports that we can send out to a client with all kinds of information in a really compact, efficient manner. I know it's budget season right now. We're kind of talking about some of that today. So if anybody, if you find yourself looking for some landscape maintenance numbers, I'd be happy to put some stuff together for you guys. So my contact information is there on the screen. So just feel free to give me a shout and I'd love to chat. So thank you guys for having me.
Thank you, Emily. Really appreciate your sponsorship. And, as we kind of progress through these unique times, it's great to provide opportunities for you to just really showcase your business. And we appreciate you as an allied member. So thank you again.
Thank you.
So let's jump into the program. And so back in June, I'm also involved with a BOMA international group called the National Advisory Council, acronym as is so prevalent in our industry. It's NAC. And Mark was speaking during one of our sessions. And I just thought it was just such a great presentation, very insightful. And so I'm really happy that Mark has agreed to present to you all y'all, I should say, today. And as you listen to Mark, I'm sure you're really going to walk away with a few things to really think about as you prepare for your 2021 budgets, but more importantly, reforecasting in 2020 and preparing for your 2020 reconciliations. And so a little bit about Mark. He is founder, chairman, and CEO of Visual Lease. Prior to Visual Lease, Mark practiced law in New York City, where he negotiated commercial leases. As an attorney and leading expert on commercial lease negotiations, lease interpretation, and expense reimbursement clauses, Mark founded KBA Lease Services in 1985 and Visual Lease in 1986, with a vision to use technology to improve the management and performance of leases. Mark received his BA from Temple University and his JD from Georgetown University. He is a member of the New York and New Jersey bars, so please welcome me sorry about that. Please join me in welcoming Mark Vitesh. Mark.
Hey, good morning. Thanks, everyone. Can you guys see my screen? You see the presentation slide? Just want to make sure. Yes? Yes, you can. Okay.
Yes,
All
we
right,
can
cool.
see it.
All right, great. I just want to be sure. Yeah, so I've been around a little while. It's an interesting journey that I was on. I was practicing law in New York, and I was doing a lot of commercial leasing, some for landlords, owners, and some for tenants, mostly commercial office space, all commercial space, but mostly office space. And an interesting thing happened to me as I was negotiating, on operating expenses and all of those things that are so near and dear to those of us who have to deal with these issues every day. Going through and positioning as a tenant, I was representing a tenant this particular day when this happened, when this enlightenment happened to me, this epiphany. I was arguing over, when the tenant pays and when the tenant doesn't pay for certain operating expenses, and going down the rabbit hole of, well, under these conditions we pay, but under those conditions we don't pay, and the clause goes from being, a simple, one paragraph clause to being 5 pages long of all the conditions and all the exclusions and all the inclusions and all the caps and whatever. You guys know this. And at one point, the landlord looked at me and said, "Mark, who's going to read the lease? Who's going to read this? Nobody's going to know what this lease says. So if we inadvertently bill your client for twice what they should be paying, they won't even know, because the lease is going to end up in a drawer someplace." And I said, what do you mean? And B, what do you want me to do about it? My job is to make sure the lease reads properly. It's up to the client to make sure that they are getting, both landlord and tenant, getting the benefit of their bargain. Make sure that they're getting what they thought they were getting. And with that, I realized, if tenants aren't checking, they really need some help. They really they don't understand their own leases. And so I decided to start a business where we were going to check leases for commercial tenants, and we had to pick one side or the other. We picked the tenant side to check to see whether or not the leases were being followed when it came to operating expenses and the other non-base rent financial terms in a lease. And lo and behold, there were a lot of mistakes. And the mistakes were not intentional, because we saw mistakes going both ways. The mistakes were really a reflection of the exact same reality that he presented to me, and that is, people don't read their leases. They go through a lot of effort. There's tons of money that's spent, both between brokers and attorneys and principal time in getting these deals to read the right way. And then people just don't pull the leases out unless there's a problem, and a problem that they say, oh, let's check the lease to see what that is. But in the absence of a problem, everyone thinks it's fine and nobody really looks at it. So I built this company, KBA Lease Services. We were really, those don't hate me, but we were the pioneers of the field of lease auditing. This was 1985. And just make a little correction to what Mark said. After about 10 years, we started the technology company. What I realized is, after doing this for 10 years, and we were representing major companies, and one of our biggest clients was AT&T at the time, and we're working all over the country, we realized that nothing changed. That even after 10 years, we would go to a client and we'd say, okay, let's take a look at your leases and let's take a look at your bills. And they'd give us a file. And on the left side was the lease with a double punch on the top, and there was a lease document, 150 pages of it, between the lease and all the amendments. And if you read the lease, it says the tenant, for example, doesn't pay for after hours HVAC. And you look on the right side of the file, And there's a bill right on top for after hours HVAC, stamped paid. What's wrong with this picture? And the reality is no one's reading the lease. And so we said, this really can be solved with technology. And so we built a platform in 1996, 10 years later, called Visual Lease. And Visual Lease was designed to bring the documents forward. They're designed to bring all of the terms of a lease that people need to keep track of to the fore so that they can access them quickly. We standardize the clauses, for tenants, unlike for landlords. If tenants have 100 leases, if landlords have 100 leases, they're typically on 2 or 3 different lease forms, but they're all very, very similar. If a tenant has 100 leases, it's 100 different lease forms because every landlord has its own lease form. So it's very difficult for tenants to track and to understand and to standardize and to be able to look from both a micro and a macro level to see what their obligations are, what their rights are. And leases aren't cheap. They're for tenants, they're one of the biggest expenses after payroll. So it's very important that they track these transactions, but a lot of companies don't. So we built Visual Lease, and Visual Lease has become one of the leading products for that marketplace, for the commercial tenant marketplace. It's not a landlord product per se, although landlords can use it, but it really focuses on finding ways to standardize and to collect transactions. It's not an ERP system. It's not for most landlords, your business, the business is that of real estate. For most tenants, their business is something else. And real estate is really a side function. So they don't need the same functionality like an MRI, or Timberline or anything like that. It's a different set of functions. But in any event, that's what we've been doing. And over the years, we've been working with this, also doing a lot with the lease accounting space. Of those of you familiar with what's going on, and if you're dealing with it, I was tapped to be one of the participants in the roundtables with FASB in trying to come up with the ASC 842. And we've been very much in the forefront of that, and our system does all the calculations that you need to do that. So this has been a hot topic for us. In the middle of all this, operating expenses and taxes have continued to be a real problem area. And there's a lot that people just don't quite see it. They don't quite understand how they work. I know most of you will know because you deal with it. It's your business. But for the tenant side, most of the tenants don't really understand it. And so what we want to do today is talk about how I just want to kind of set the stage for how OpEx and taxes and pass-throughs generally work, how they look from a 30,000-foot view, and then dig in a little bit to some of the rules that pertain to them, and then how those rules are impacted by what's going on now with COVID and with the changes in the way buildings are operating, and what the impact might be on these pass-through provisions. So what I'll do first is kind of talk about tenant liability in normal times. We'll talk a little bit about gross ups, interesting concept about gross ups, and we'll talk about that. And then we'll talk about COVID and other issues. So tenant liability in normal times. So after looking at leases and looking at the different structures, because we see so many different kinds of leases, I realized that the best way to describe the lease types is on a continuum from pure net to pure gross. And if I look at those two extremes, you look at what most leases are, and there's some kind of combination or some kind of somewhere else on that continuum. And everyone makes the mistake of calling lease types incorrectly. They'll call it net, they'll call it triple net, they'll call it single net, double net, modified gross lease, base year lease. They'll call it all these different things. So what I like to do is sometimes just kind of set the stage and describe that continuum And so we can use the same terminology, and you guys can use the same terminology too when you think about these things. So when I look at net versus gross leases, the real core is are the expenses for operating the building built into the rent or not built into the rent? Are they included or are they not included? Pure and simple. On a pure gross lease, the tenant writes one check and that's it. It's one check for the rent and it covers everything. The landlord is required to, someone's got to, somehow the building expenses have to be paid for by the tenant, right? It's just a question of how. So on a pure gross lease, the tenant writes one check, everything's included. Nothing else, there's no extra charge, there's no extra charge for taxes, everything's in. That's a pure gross lease. The other extreme is a pure net lease, where the rent only captures the use and occupancy of the building or of the space. It's only covering the cost of the asset, not anything else. It has no operating component to it at all. It's just you're getting the space, and now we have to figure out how you're going to pay for it. The tenant pays for the cost of running the building, running the space outside of the rent. So the rent has nothing in it but use and occupancy. And by the way, when it comes to the lease accounting rules, on the tenant side, on the occupant side, the lessee side, you're only capturing that pure net component. You're not capturing all the expenses. So it becomes relevant with lease accounting, this distinction between pure gross and pure net. So if you look at the pure gross and you look at the pure net, and you say, well, some expenses are covered and some are not, well, that's something on the continuum. It's a gross lease with something in between where the tenant doesn't write one check, they write more than one check. And the number of checks that they write is really dependent on the structure of that particular deal. And by the way, you can have a pure gross lease, and to accommodate increases in cost of operating over time, you can create bumps in the rent, right? We've all seen that, right? It's so much in year one and a little bit more in year two and a little bit more in year three, where the landlord anticipates the increases that are going to come for cost of operating the building. And so you build it up, but it's still one check. Tenant still writes only one check. Now, if in that situation, the owner, the landlord, takes all the risk. The tenant takes a risk too, because they might be overpaying by paying that one check. But the landlord takes the risk because if there's some big change that happens and the expenses go through the roof, the landlord is on the hook for it and has no recourse against the tenant. In fact, there's a story about a building in New York City back, I think it was in the 70s when there was hyperinflation. And a building in New York was leased to Sears Roebuck, and it was like, half the building, a big chunk of the building on a pure gross lease with some increases that were built in, but it was a pure gross lease. And when hyperinflation hit in the 70s and it made the expenses rise by 20% each year, the landlord had lost the building, couldn't afford to operate the building on the rents that were being paid by Sears. So you got to be really careful, the risk now. In a pure gross lease in today's environment, where expenses might drop, the landlord is still collecting the same check, even though the expenses are significantly lower. So it's a question of where the risk is, but that's the format. Now, I guess what happened over time is that tenants said, "Well, I don't want to give you a big check. It's too gross. It's an overpayment. Let's get this a little bit more precise." And so the mechanism that was developed was, well, we'll do a gross lease, and the lease will cover all the expenses of operating, but just for the first year. If the cost of operating the building increases, then the tenant is going to pay the incremental increase in the cost to keep the landlord whole. Makes sense. So you say, okay, increases over when? Well, increases over when we sign the lease. So when you sign the lease is defined as a base year. And you say, well, okay, if the expenses, we have to take a snapshot of what the expenses look like in the base year. And we'll say if that snapshot changes and increases over time, the tenant is required to pay to keep the landlord whole. And there you go with it's not a gross lease, it's a modified gross lease with a base year. Very simple. You have a similar mechanism with an expense stop. So you don't have a base year, you don't look at the real expenses in the base year, but instead you pick a number. And those of you that have leased to the GSA, that's the way it's done. You have a number that's agreed to as your base starting point. It's not what the expenses turn out to be in 2020. It's a number. It's $12.43 per square foot, whatever it is. It's some number that is agreed to. And then there's a mechanism for measuring increases. So an expense stop is an agreed to base year, it's an agreed to number. And then you can measure increases from there. Or in the case of the GSA, they take the $12.43 and they peg it to the CPI so that the CPI tracks increases. It's not accurate. It's not exact, rather, but at least it captures the increasing cost of the cost of living. Interestingly, I'll bet none of you have ever heard of something called porter's wages, but in New York City, back, I don't know, it's probably in the early 80s, the idea of having expenses pegged to the CPI became disfavored because building owners would say, wait a minute, I'm not going to peg my increases to the cost of consumer prices. Consumer prices are the cost of butter and milk and gasoline. And, these are not things that drive up the cost of operating the buildings. The cost that drives up the cost of operating the buildings is the cost of labor in New York. And labor in New York is all unionized. So instead of using the CPI to measure a basket of goods and services over time, we're going to measure the wage rate of unionized building workers and look at it's a negotiated rate every year, every 3 years it gets renegotiated. And we're going to look at the hourly wage rate for the building class called porters. And if the porters are earning $10 an hour 1 year and they're earning $10.50 the next year, that's a 5% increase. We're going to use that 5% increase to instead of a CPI, we're going to use a 5% increase because it's more accurate for measuring the actual cost of operating a building in New York. Makes sense. What happened was, after a while, some landlords got cute and they decided to change it from a percentage increase, which makes sense, to what they call penny for penny increase. So if the wage rates for building porters went from $10 an hour 1 year to $10.50 the next year, instead of measuring a 5% increase and applying it to whatever the base expenses were, they said, well, it went up by 50 cents an hour, so we're going to charge you tenants 50 cents a square foot. And what happened was landlords played this game for a while in New York, and they were collecting 3x what the normal operating expense increases would be, and all kinds of things happened. When the market shifted, that became disfavored and it went away. But I like to bring up the example because it kind of shows what the mechanisms are like. You start with pure gross. You have pure gross with a base year where everyone sits around and waits to see what the expenses are going to look like at the end of the year, and say, okay, now we have the snapshot of 2020. We'll use 2020 as a measuring point, and we'll look at 2021, and we'll charge you for your share of that increase. Versus a CPI, where you wouldn't do a CPI typically on a base year, but what you would typically do is you'll have an expense stop with a CPI, or an expense stop with a porter wage, or a porter wage, which happens in New York, or you might have a base year, and the tenant might negotiate a CPI cap on the expenses to stop them from rising too rapidly over the course of the lease. But these are the different mechanisms. If you go back to the other extreme, to the pure net is simply pay your base rent and then pay your share. If you have the whole building, you pay the whole, sometimes you'll pay directly to the vendor, or to the tax authority, to the jurisdiction, or sometimes you'll pay on a multi-tenant facility. The landlord will divide up the expenses and charge you for your share of them. But you're basically paying outside of the structure of the rent. All right. Now, with the base year, and we'll talk about this more with COVID and with the changes that happen, you can see where base years can start getting thrown off. Let's hold that for a moment. Gross ups. So what's the point of a gross up? And I was arguing about gross ups back in 1985, 1986, before the term was ever coined. I don't know who coined that term. But the idea was if you are trying to capture increases in the cost of running a building, the vacancies that may happen in a building can throw the numbers off a lot. And I'll give it to you from both a tenant perspective and a landlord perspective. If a tenant occupies half the building, well, let's start with the landlord perspective. If a tenant occupies half the building, and the way operating expense pass-throughs work is, and this is the big core thing, and you guys all know this, is the building expenses are not isolated to each individual tenant. One of the most accurate leases I ever remember reading said that tenant is responsible for the expenses attributable to its space. But I only saw that once. Most of the time, all the other leases say the tenant is responsible for its share, its pro rata share of building expenses. And the way that works is you take all the expenses for the building, throw them into a pot, and the tenant that has half the building pays half of that number. Well, that's all well and fine if the building is fully occupied. But what if half the building is unoccupied? What if I'm the tenant, I'm in a building, right? And I'm obligated to pay my share, 50%, because I have half the building, of the building expenses in that building, and the other half of the building is vacant. Well, now I'm only paying half of the expenses that I'm probably causing. They're almost all my expenses. But there's nothing in the lease, in a standard lease, that says you have to do anything about that. So I get the break of paying 25% of the expenses because the expenses are only 50% of normal, and then I only have to pay half of that. So the concept of a gross up makes a lot of sense in a net lease situation, in any escalation year, in any pass-through year. But they also make sense in the base year. So if I'm a tenant and I move into that building and I have half the building, and we're looking at the building expenses for 2020, and I'm the only tenant in the building. I have half the building, the other half is vacant, and I'm going to use 2020 as the basket of expenses that I'm going to be measuring against every year. Well, hey, this year the expenses were cut in half because the other half of the building was empty. And next year, if that other half gets filled up, the expenses are going to go from here to here, because they're not only going to go up because of inflation, normal increases. They're also going to go up because we now have another half of the building that's full. So if I don't protect myself as a tenant, then I can be stuck with a base year that's half of normal. And using that 2020 number at half of normal means that in 2021, when we look at a normal year, we're going to compare it to a half of normal year. There's going to be a massive, it's going to be almost 100, in that example, it would be 100% increase. And I'd be responsible for covering 100% increase in the cost of expenses, even though the cleaning contractor is only charging 2% more next year. So as a tenant, I want to bring that base year up to what it would be in a normal building. And for a landlord, you want to bring the escalation years up, the subsequent years up, the pass-through years up to what they would look like in a normal building. And that way you're always dealing with an apples to apples comparison. If you break it down on a per square foot basis, I mean, there are different ways of doing this. For those of you that deal with retail, there are other mechanisms. There's a mechanism where you only, the pro rata share is driven by the area that's actually leased out. So if I have half the building and the other half is empty, then I have half divided by half. I have 100% of the 100% of the expense because I'm the only tenant occupying it. There are different mechanisms for doing this, but they're all trying to achieve the same thing, trying to achieve parity so that the years are normal. The idea behind pass-throughs has always been that they're not intended to be a profit center. I mean, you'll have some landlords, and you guys have, I'm sure, experienced this, that will play games here, but most people in business don't play games. Most people in business are straight and honest, and they're trying to do the right thing because their reputation is more important than anything. And so they will do these things correctly, but mistakes are made. Now, what happens in a year where the building is vacant? You have something called a gross up, which will adjust the expenses to what they would have been had the building been fully occupied, right? So that would take the expenses in the half-empty building and bring them up to what they would be in a full building. And now when you're comparing a full building to another year of full building, the increase is isolated to the inflation, which is what you want. And conversely, if you have a high, let's say your tenants have a base year of 2019, which is a normal year, and then in 2020 the building goes vacant, but the expenses for providing janitorial and all of the expenses are normal on a per square foot basis, they're normal, then you have to find some way to make an adjustment so that you don't get hurt and you don't lose the opportunity to capture the normal inflationary increase on the tenants that you have. So it all kind of fits together. The thing with gross ups is that it's not only vacancies that drive it. Sometimes other things drive gross ups. So for example, it could be that a building component in a new building or in a building that had some work done is under warranty. So elevator maintenance is normally X dollars a year, but we just rehabbed the elevators and now we have a 3-year warranty covering the cab and the mechanism and whatever gets covered. And now, so the building maintenance, the elevator maintenance drops to a nominal amount for the next 3 years. What do? Do you bring that up to normal levels? Well, I don't know if it's necessary in an escalation year, but for a base year, the tenant looks at that and says, wait a minute, I have no elevator maintenance in my base. And 2 years later or 3 years later, when the elevator maintenance kicks in, now I'm being charged for that as though it was never built into the base. And now I have to pay the entire amount for that. And so a tenant might object to that. And other things will drive this as well. So you've got to look to see what constitutes normal. What constitutes the idea of normal? And the idea is that in every escalation year, the expenses should be treated as normal. They should be adjusted to normal so that both landlord and tenant get the benefit of what they thought they were getting, which is, hey, the tenant says, hey, I'll cover you if your costs go up, because you shouldn't be eating into your profit to pay for increasing operating costs. But it shouldn't be a profit center either. So it's a balance that has to be struck. And we've done tens of thousands of these, and we always end up in these discussions of what's really the purpose. I mean, the purpose was not to try and overcharge your tenant, and that's almost never the case, because this is really peanuts in comparison to the overall customer revenue coming in from that tenant. You just want to be sure that you're doing it fairly and accurately. And so that's really the goal. And when we do our work, we're always looking to see what was really the deal. What did everybody think they were getting? And let's make sure that that's fair so that everybody is comfortable going forward and they don't feel like they're either underpaying or overpaying, or under receiving it or over receiving. So again, the key with tenant liability in normal times is that you have to have consistency. The base year, if it's a base year lease, has to be consistent with the other years. Otherwise, you get these crazy anomalies. Now, if you take that, some COVID issues come up. So we see the fairness of grossing up. grossing up without lease language, like I said, we've been arguing about gross ups for years. The first time it came up with us was I saw a building and they had all kinds of cleaning credits in the base here. And I said, what happened? They said the tenant never moved in, so we didn't have to clean their space. I said, yeah, but you're setting their base here where it should be here. And we had to make an adjustment, and everybody agreed. They thought that was the right thing to do. But what is fully occupied mean? And the way the lease clauses read is, if the space is not fully occupied, if the building is not fully occupied, then the expenses need to be adjusted to what they would be in a fully occupied building. Great. All right, everybody. What's fully occupied in 2020 mean? Does it mean fully leased? Does it mean fully occupied with people there? What does it mean? And how does that adjust? What's the right temperament? What's the right way to look at this in determining in determining what normal is, so you get normal versus normal? You don't want to charge tenants for expenses that don't exist, right? You don't. That wouldn't be appropriate. But at the same time, you don't want to not collect the right amount of revenue. So the idea is you always keep your eye on the ball, and the eye on the ball is you have a lease that's in place with a pass-through structure that's intended to keep you whole, so that you're not exposed as an owner. You're not exposed to the risks of fluctuating expenses, where it might impinge and might eat into your net. So you have to be careful there, but you also want to be fair. So that's really the thing. And so fully occupied in these days, I mean, I know we're 150 people working from home. We were 150 people working in an office, still paying rent. Our office is still there. We're still occupying the building, but we're not cleaning the space. We're not using the elevators, right? We're not using the electricity. We're not using anything. We're not there. We're all working from home. What is the appropriate adjustment? And you have to go back to what the purpose is, because if my landlord were to bill me for cleaning expenses that didn't exist this year, I wouldn't be happy. And that makes sense. Conversely, if this were my base year and I negotiated the lease before COVID hit, which is the beginning of the year, and I expected the expenses to be normal this year and they came in subnormal because of what's going on, I wouldn't want 2020 to be in this subnormal state, to be the expense level, because when I negotiated my lease, I negotiated a gross number that contemplated full building expenses. It contemplated full building expenses at full expense levels. Nobody knew this would hit. If you were going to negotiate a lease today in the middle of the summer, knowing where COVID is, you'd do a different deal. But if you were doing the deal in January or February or last December, your rent number is predicated on what the expected expense level is going to be for 2020. Your base was set that way, just like your budgets are set that way. Everything was set that way. So some adjustments would need to be made just to make sure you're preserving the intent of the deal. 95 versus 100% occupancy. Interesting issue. The thing is that the reason you do a gross up adjustment is because you want to bring things to normal. If you bring them to 95%, that's not quite normal, because the tenant should not be paying even for a 5% increase due to occupancy. And you shouldn't be getting less if it's at 95% from a landlord perspective. 100% is the right standard to use in all these cases. All right. So looking at COVID and R&M and base janitorial and all the other expenses, obviously they're all being impacted. I'm curious to know if any of you, I kind of know the answer already, but I'd be surprised if any of you have adjusted your 2020 estimated payments from your tenants because of COVID. I don't have, let's see, I don't know where this chat feature is in this in this thing, but I don't know where it is. But in any event, I'd be curious to know if people have made any adjustments to the 2020. And I'm curious to know what you're doing with your 2021 budgets, because your 2021 budgets are now, who knows what they're going to look like. I would anticipate that they'll probably be set at normal levels, assuming that, on the wishful thinking that we'll all be back to normal by the end of the year, and that 2021, and that in 2021, 2020 will be a thing of the past and was something we'll try to bury in our memories. But 2021 need to know what that looks like, and what the budget looks like for 2021, and whether you're making any adjustments. Obviously, the estimated charges that are coming through every year are only an estimate, but right now, because of the fragility of the markets, it's imperative that you're collecting as much of those estimates as possible, because you don't know what you don't know what companies' financial conditions are, and we're seeing certainly a lot of shrinkage. I'm interested to know what's happening with your market as well, and we see it. We see it with our software. We see some shrinkage. It's a little too early to see, but I anticipate probably an 8 to 10% net reduction in office use around the country, which to me is it's an absolute huge number. But I think that's what's going to happen. At the same time as you have decreases in operating costs because of reduced janitorial, you're going to have some increases too because of increased security, increased cleaning in common areas. I don't know what the expenses look like this year. If someone can sort of chime in and let me know where you see the expenses for 2020 landing, whether they're higher than normal because of the increases, or net lower than normal because of the reduction in use. I'm also interested to know to what level your buildings are occupied and what the nature of those occupancies are. I would expect to see higher occupancy with industrial usage, but then lower when it comes to retail and to commercial office space. So I wanted to leave a few minutes for Q&A. I think there are a whole bunch of Q&A here. Yes, there are. And let's see, I figured out how to do this. All right. Let's see if I can figure this out for you guys. Okay. Someone said, yes, they did a net operating income reforecast. Someone else said, we have not reduced our expense billings to the tenants. Someone else said, we have had requests, but have not necessarily adjusted our own unless for a single tenant user. Someone else said, we have not adjusted. 2021 is being compared to 2019 and 2020, depending on the expense. Someone else said, we're not adjusting our CAM estimate billings. I could tell you who the names are, but I won't. We have not adjusted and are budgeting based on normal conditions. I think that's probably the most appropriate thing. I mean, nobody knows what's happening until it settles down. Our expenses are lower than normal due to decreased occupancy. We are saving in some areas and increases in others due to added costs. As I said, janitorial expenses have decreased somewhat, but if there are 3 employees in a suite, we still have to clean the entire suite. So expenses haven't decreased as much as you would think. Interesting. And the last comment is, overall, we are lower than budget, but after grossing up electricity and janitorial, we might be over. So I think when we look at this, there's a couple of other things that you got to be careful about. So expense caps that are in place tend to get funky in normal conditions, right? And the whole thing with expense caps is, expense caps tend to contemplate that expenses are always going to rise. right? Because that's the norm, right? So expenses are always rising. So if it's $10 a square foot, it's going to go to $10.50 and 11.50, whatever, and it's going to go up. And if you cap, let's say you cap, and instead of being $11, you cap it at $10.75, then the perennial question is, well, are you then measuring your cap from $10.75 or from 11? Is the cap cumulative from the beginning of the lease to the then current year, or is it incremental from year over year? We see language that talks about compounded, language that talks about cumulative. We see language that talks about both compounded and cumulative, and nobody really has a clear picture of what it is. The problem also is, what happens if the expenses drop? So a cap will limit it from going 10, 10.50, 11, so it goes 10, 10.50, 10.75, let's say. And now you're measuring from there. What happens if the expenses drop? What happens if it goes 10, 10.50, 11, 10? It goes back down by $1. Where do you measure your cap from? Is your cap, again, cumulative? So you're measuring, let's say it's a 50-cent increase cap. Do you now have in that next year, do you now have 3 50-cent or 4 50-cent amounts that are going to set your cap? Or is it 50 cents over the $10? Do you reset everything back when the expenses drop down to $10? And now is it the following year, 10.50 from 10? Or is it 50, 50, 50, 50, and it's $2? Big question. A lot of your leases are not going to be clear. And I'll bet you if you read them, and this is one of the issues that we look at in our lease audit business, is what does the lease say? What did it mean? What's the language? How does the language read? What did the attorneys try and accomplish? And we very frequently find that there was no real meeting of the minds. Everyone thought something different, and then we have to figure out how to reconcile that. But the anomaly of throwing expenses into a pot, dividing them back out, using base years and using measuring, those two factors really create a myriad of different complex situations that you have to watch very carefully. Now, if you have net leases, the net leases are a little bit cleaner. And so you don't have you can still have caps, but they're a lot cleaner. And with the lease accounting rules, what might be happening in the marketplace is because the rents are being isolated between the base rent expenses and all the operating costs, you might start to see more net leases in the marketplace and fewer base year and modified gross leases. The way the lease accounting works, as you all know, is that you take the base rent expense for a tenant, you look at it over the life of the lease, you do a net present value using an interest factor, and then you capitalize the expense. So this is something that we're seeing a lot of. But because they're doing it that way, the operating expenses are not being captured in the equation, and therefore the base rent is being identified in these leases. And if the base rent is going to be identified and isolated in a modified gross lease, what's the point of having the modified gross lease? You might as well make it net. The whole thing with the modified gross lease is that the tenant saves some risk, pushes some risk onto the landlord by saying, I don't care what the cost of the building is. It doesn't matter what it costs in 2020 or 2019, let's say. It doesn't matter what it costs. Whatever it costs, you're eating it, and I'm just going to pay for increases in that number. And so the tenant shifts risk to the landlord in that situation. And so at the end of the day, you don't know how much of the rent is really base rent versus operating costs until the end of that year. You don't know, because you don't know how much the operating costs are until the year closes. So if you're going to identify how much the base rent is anyway, you might as well do a net lease, and there's no reason to do a base year lease. So these are trends that we see happening over time throughout the market. We'll be able to provide insights on these. If you visit us on our website or you want to email me, I'm happy to provide any additional information. And with that, that's about all. Yeah, Amy is saying those who want to receive CE credit has to fill out the form. There's a link in the chat right now that she's posted, and hopefully it's been useful to you all. Amy?
Yeah, that's a great, really good insights. Me personally, not being a property manager, it's always helpful for me to hear all this stuff. So I'm sure all of our members appreciate it as well. We had a good participation today. I appreciate it. Thank you to Mark with a C, who knows how to spell his name right, for his time today. A lot of thank yous coming in through the chat room. I'm very happy to see some familiar names in there. Some of those folks that really appreciate educating themselves during this time. So I'm going to leave that chat room box open just a little bit so that people can grab that link for the survey, and I will pop it in there just one more time. So if you're getting continuing education today, thank you for filling out that link with your license number. Mark, will you send me this PowerPoint
Yes, I
to
will.
my email so that I can send it to the attendees that are registered? That way they have that information right there.
Sure.
They have the slides, and that way they can reach out to you with further information.
It'd be my pleasure. And thank you all. And it's funny, you know, I typically speak to groups of tenants, and I don't often speak to groups of owners and landlords. And I always appreciate the perspective. And I always think you guys all know this stuff down cold, and maybe you do, maybe you don't. I don't know, but it's always good to clear the light and to clear out some of the chatter.
All right, and Mark wants to ask a question. So Mark, if you want to do it verbally, I'm allowing you to talk right now, Mark, if you want to ask the question.
You're on mute, Mark.
Let's see if I can unmute him.
Okay, can you hear me
There
now?
he is.
There you
Okay,
go.
perfect. Hey, Mark, thanks again. I mean, just very insightful. And although a lot of folks probably